All right, welcome everyone. Thank you for joining our Edgewood webinar. We are going to go ahead and get started. Quick overview of the webinar and how it'll be conducted. We'll go over the sponsorship team, and then we'll give a quick investment summary. We'll go over the market, our business plan, and then a quick overview of the financials before we open it up to Q&A. Disclaimer, this is a 506 accredited investor only offering, and a subscription can only be made after reading the definitive prospectus and deal documents, which we expect to be available in the next couple of weeks. So I'm Mike Gilman, the founder and managing principal of Cross Mountain Capital. I've been personally investing in real estate for close to a decade. First, as when I was an attorney on Wall Street, I supported trading businesses and investment banking businesses, and really wanted to invest to build wealth for the long term. And after taking a look around, I came to the conclusion that real estate provide the safest returns and the least volatility over a long period of time. Prior to forming Cross Mountain Capital, I managed a $250 million residential portfolio at EasyKnock, which is a real estate-backed, venture capital-backed real estate company. Most recently, when COVID started and the Fed started its unprecedented monetary easing policy, I decided it was time to ramp up because I saw that there was just, as always, a lack of real assets, especially quality assets, and the money supply was increasing, and property really seemed like a sure bet, as it always was. But really, on the back of this easing cycle, we started ramping up. Last year, we did about 300 units, 225 million in acquisitions that we originated and managed. And we've been growing rapidly. We have a team of five people. Our newest senior hire is Eugene Yampolsky as head of asset management and underwriting. Eugene brings with him decades of experience working on and managing real estate in a consulting capacity with a family office. And he's also a proprietary prop trader, he's managed multi-million-dollar books and has developed an exceptional track record there. He's a CFA charter holder and is graduated from the NYU Stern School of Business. Here at Cross Mountain, we have two primary strategies. One is a high cash flow tertiary market strategy. This is how I got started in real estate. I'm based in New York. I started investing in northern New England. Took me to Vermont, New Hampshire, higher cap rates, and just really safe investments and not much in terms of competition. That's how I built up my portfolio, and I was able to transition to do real estate full time and do what I love, which is bring deals to market. About a year, a little over a year and a half ago, when COVID hit, I wanted to enter a market I've been watching for a while. This is the Colorado Front Range, and I knew I needed an edge. At that time, I found offered. There was no one doing anything remotely close to what they were doing, which is combining data warehouse machine learning with actual off-market acquisition. So you could cherry pick assets and send their team a list off their database, and they would get to work sourcing deals. So I came to them targeting heavy value add opportunities, which in a competitive tier one market with low cap rates, that's our primary strategy: get in and out, crystallize that, reposition, and move on. So 2 years ago, I came to Offered, and we did our first deal together. They found a splendid asset, Ingalls Grove. Some of you are investors there, and I see you in the webinar. That asset has been doing exceptionally well. We're about a year ahead of schedule on renovations, and in a year we've turned 54 units, actually about 5 left at this time, and so we're well ahead of schedule, and we'll go over that deal specifically, and how we're coming in above projections on rents and timeline. Since then, we've been underwriting deals, nonstop with Offered. Particularly, again, I focus on the off-market campaigns. And about a year later, after nonstop underwriting, we were able to find another unique opportunity, heavy value add reposition. And before I introduce the rest of the team, I'd like to hand it over to Offered and to Gunnar specifically, who will be speaking on their behalf.
Thank you, Mike. I appreciate that. And thank you so much for everybody to be on the call, also from Offered. I'm coming live to you from the multifamily conference in Orlando. So thank you for bearing with me on some background noise that you might be picking up. Like Mike said, we have been working with Cross Mountain for 2 years now. We sourced the Ingalls asset, and that has been going great. And now we're very excited to have found this one and to co-sponsor this deal with them. Offered really solves the #1 problem that multifamily investors have right now, and that is finding deals. We have a very advanced technology platform and a dozen acquisition VPs that help us source deals. And so we were able to find this particular asset. And the reason that we like it so much is because it checks all 3 boxes. It's a great value add asset. All this investment does really. It's a great value add asset. The sponsor is Mike and his team, outstanding, experienced in the market. In fact, they have a very similar asset, like you said, just down the road. And that one is ahead of schedule, doing very well. And third, we have an excellent local team on the ground in 3Gen, which you will hear more about. And between all those 3 things, this is a great opportunity. Just real quick, my background is private equity, single-family rentals, multifamily, other asset classes. And I am the president of investments at Offered. So in case, for everybody who decides to invest, we might be interfacing. Travis, unfortunately, he's tied up at the conference, so he won't be able to be here. But he founded the company 3 years ago. And, it's been an interesting ride. And we are very proud and excited to bring this deal to market together with Cross Mountain, Mike and his team. So now we'll shut up and we'll get into the meat of the presentation, which is much more interesting. So I hand it back to you, Mike. Mike, I think you're muted.
Thank you, Gunnar. So before we get started, I just want to introduce one of the key members on our team that's really responsible, by and large, for the success we had at Ingalls and which we hope to replicate here. This is 3Gen Construction and Property Management. They specialize in value add execution through in-house construction and property management. We specifically love them because they're investors themselves. They do their own deals with their own capital. And they're quick, they're nimble, they're efficient, and they're really an operator's dream partner. Me, myself, when I built my portfolio, it was self-managed. We have a property management affiliate. And so I get really into the weeds here, and it's rare to have a complement like this on all in one on the property management, investment, and construction side. With that said, I'll turn it over to Phil to quickly introduce himself.
Good afternoon. I appreciate the compliments. Like you, I've got a good team behind me, and they're doing a great job. So we've built our firm to be tailored to property manager or to investors. We don't deal with people that aren't investors. All that we deal with is investors, whether it's through some different buy and hold strategies on the smaller stuff to property management. And we specifically built our firm to be able to do everything in-house. So there's nothing that we can't help any real estate investor in any, asset class within the real estate investing world do. One of our claim to fame is we've actually worked with a lot of smaller people, and we've turned flipping stuff into a passive investment. So we try to take everything hands-on from start to finish. It's been great working with Mike and his team for the past year. The Ingles project has gone very, very well. Few hiccups notwithstanding. We're trucking right along. We're apparently ahead of schedule. I feel like that's the schedule that I thought we could hit, and so far we've been executing it. So
You're ahead of our schedule, our pro forma.
Yeah.
Not your schedule.
Yeah, I tend to be a little more aggressive in my scheduling to try to get things done. And that's what we've done. Through some extra luck, if some extra people would have been gone, we could have been wrapping this thing up already. So we've had good luck there. And I meant to say at the beginning, I apologize. My partner, Sean, is not here. He's dealing with one of the new challenges that we're facing, and he got COVID yesterday. So he's a little under the weather, but we'll truck on without him. So with that, I'll give it back to Mike. But that's literally what we try to do, is everything that this deal encompasses is stuff that we do, from helping to, at the beginning, assess it, helping to inspect it, helping to rehab it, manage it, help figure out creative strategies that can increase profitability along the way. That's literally all that we do and all that we focus on here at 3Gen.
Thanks, Phil. Okay, moving on. We'll quickly take a dive into an investment overview. So our purchase price was originally $18.5 million, and we got some credits to the tune of $412,000 after inspection, and as well as taking over a fire damage claim, which we'll get into. It's a Class C building, workforce housing, 112 units, 1970s vintage. We're coming in at a very attractive purchase price per unit. Again, we'll display the comps later on. Investment strategy is heavy value add, and we're looking to hold for a maximum of 5 years and realize returns, target returns as soon as we can, hopefully so much sooner than that. The current NOI is $400,000, severely impacted, about 75% occupied, and we'll go over into some of the mismanagement there and why. By filling the building and renovating and bringing rents up to market, we will increase NOI by year 3 significantly. Now, we'll go over our underwriting, and we'll go over how we believe our projections are conservative. Quick overview of the deal structure. So investors will receive a 10% preferred return. So that means they will receive a full return of their capital and a 10% IRR before there are any distributions made to the sponsor. After investors receive a 10% preferred return, the sponsor will begin getting a 20% distribution cash flows, and investors will receive 80%. After investors receive a 20% IRR, the split will then turn into a 65-35% split, with the sponsor getting 35% distributable capital. We're conservatively targeting an IRR north of 22% and equity multiple north of 2.25. The deal has an average cash on cash of 6.5. Here at the bottom, we've modeled what distributions on a hypothetical 100,000 investment would look like. Year 1, the property is not cash flowing too well on account of the renovation schedule, the vacancy, and us turning the building. By year 2, we will have completed the reposition, and we'll do a cash out refi. That's where that lumpy payments coming from. And after that, we'll make steady distributions on cash flow as the asset kind of matures and takes part in the organic appreciation of the market. Now, of course, we don't rely on organic appreciation. This is a heavy value add deal. A quick overview of the investment highlights. Really heavy value add. When if you were to, I would put this building in the textbook if I was going over what heavy value add looks like. Everything about it, from the management. When we were on site, we toured, there were about 10, 12 vacant units we were able to tour. And they were just in various states of disorder. Not much was needed. A quick turn that the 3Gen we've done in a day for most of them. And we just witnessed the staff just milling about, kind of no direction and no coordination, and just vacant units just sitting there. They're pretty much ready. We'll show some of them in the pictures. In addition to this gross mismanagement, the building had a fire. It was caused by a tenant. It spread to a couple other units, and they've just really struggled with bringing those back online. And we attribute that just to, again, bad management. The manager seems to be the nephew of ownership, absentee ownership, and is not a professional operator. There's no kind of integration with any construction or anything. In addition to that, just looking around the market, buildings are 100% occupied. Right across the street, we'll point it out, is a building of exact same vintage, Candlewood, 100% occupied at higher rents. And again, this is unrenovated. Another big highlight here is the early return of capital after the reposition, and then significant equity appreciation from the reposition, and from lowering operating expenses. Again, not relying on any kind of organic growth, which this market, of course, has experienced and is experiencing, and we, of course, believe will experience. Number 3 is track record in the submarket. We can provide, our kind of documented Excel sheets with deals we've done and 3Gen has done, and just extensive experience with 3Gen here in this market. And really, we've partnered well with them to the point where we consider it as close to vertically integrated, and they are on the sponsor team here. Next, we have exceptional market growth and fundamentals. Of course, Denver is perennially on top 5, top 10 lists. And also fitting in with our investment strategy is we're investing exclusively in markets that are benefiting from what we view as a generational change in how and where people want to live. In a city, MSA like Denver, the trends will show people migrating out of the core into these first ring suburbs like Westminster, very desirable. We'll go over that in a bit. Another great benefit is the low maintenance cost of the property. It's got a very compact footprint, which we'll go over, and that's going to be very helpful with landscaping and groundskeeping. Also very, very favorable is on-site management office, which we will staff with a property manager to facilitate administration. And lastly, our underwriting is replete with conservative inputs that we'll go over. And for this deal, we're using a repeat lender, LaSalle Debt Advisors, who came in with 85% loan to cost, and that might go higher on account of our credits that we negotiated. Quick overview of the market. Again, Westminster is a first ring suburb here outside of Denver. It really prides itself in its outdoor spaces and a great school district and just a high quality of life. Some quick COVID stats. You could see how rents have been declining in the core and increasing in the suburbs here, and just mass migration of population, which we believe this is here to stay, given what we've studied in terms of the amount of companies that will convert to permanent work from home, it's not going to be 50%, but even if it's 10%, that frees up. That's a massive amount of people that are really, we're in the first inning of a generational migration change, is our view. Again, we're not relying on any of this organic growth. We are here to make money as is with forced appreciation, and the organic growth will certainly be a benefit. Just a quick overview of Denver. Again, any given year, it's appearing somewhere on some top 5 list for growth and across all areas. Really like this snapshot here of the rental market. You can see how competitive it is. 27 days is the average vacancy. Vacancies hovering below 5%. And you have 14 renters competing for a vacant unit with a 660 average credit score. Again, that vacancy rate, takes into account all operators. We think we can beat that 5%. Of course, we haven't modeled it more aggressively. A quick look at the location. You could see the asset here. It's right next to Westminster High School, really desirable, highly ranked school in the suburbs. Right beside it on the right is Candlewood. It's the building I was referencing, which is the same vintage, 100% occupied, and higher rents. So just case in point, there's really no reason this shouldn't be 100% occupied. Looking in, again, just highlighting the compact footprint of the building, a nice compact courtyard that we will upgrade and transform, and a nice compact parking lot ringing the building with minimal other landscaping needed. Again, we have some more exterior photos here. On the interiors, the units aren't, they're in good shape, as you could see, which is, again, a head scratcher as to the vacancy. So actually, one of the things we did in the underwriting is we didn't factor in that some of these units are in good shape. For example, on the top left, that vinyl flooring might stay, giving us some gains. But again, we haven't factored that in. We've modeled it as a gut renovation, and we'll go over what that entails shortly. Current rental comps, you can see Edgewood for a Class C property is really at the bottom of the pack here. And hopefully we can understand why from what I've gone through so far. Recent sales comps, we believe we're coming in below market here. We'd like to highlight from this comp set, Boulder Crossroads, about a mile away, traded in July of 2021. And you can see here we're coming in below that to the tune of 10,000 a unit. Business plan is a simple one. It's decrease operating expenses, increase rents through, first of all, for this building, it could be done through efficient management, but we're going to reposition and upgrade the units and look to target the B minus asset class and benefit from that rent bump. Now, this is an asset class that there's not much of in Denver. It's people are building new construction, or there's a lot of this aged inventory. So we do strongly believe there's a shortage of Class B, and we see that in our existing portfolio and the demand we've had for our renovated units. We will look to refinance after we've repositioned, and we conservatively expect that'll result in a 50% return of invested capital by the end of year 2. Throughout this period, we'll administer distributions on a quarterly basis. For this deal, we probably start them in the 3rd or 4th quarter. It will take some time to get this deal up into cash flowing mode. Lastly, we will look to exit during an opportune time. And again, this can be before year 5. And most important to us, of course, is our view on when in the whole period we can get the highest returns for investors and ourselves. Rent roll projections, we are under market here after completion, and we'll go over the comps shortly. But you can see we're modeling anywhere between an 11% and 25% increase after renovation. Just taking a look at how that stacks up to comparable Class Bs, we can see that Edgewood again here we're very conservative in our projection when we're coming in well below what we view as potential competition. So here's an example renovation we did at Ingalls, which we'll seek to replicate here. Just a quick note on that deal. As I said, we are close to 1 year ahead of schedule at this point, with less than 7 units left to complete. We're above projected rents during the construction phase. 1 bedrooms are renting at $1,300 versus it's a typo there. Sorry. Okay, place back. Versus 1,180. And 2 bedrooms are renting at $1,500 versus our model of original model of $1,420. Again, this is in the middle of mass construction. I mean, Phil's team rolled in there and just starting the whole thing, and so we really expect some bumps there. What's more is we believe investors are now on track to hit their target returns this year, and we can contemplate a sale instead of refinance. On the exterior renovation side, we will transform the courtyard with some in-demand amenities, namely a dog park, maybe some grilling stations, and we'll improve the walkways and breezeways and add landscaping. Jumping into the financials, we're going to just quickly go over some of the assumptions. Year 1, we project rent growth, followed by a 5% bump in year 2, and 4% every year thereafter. This is well below consensus projections for this submarket. Year 1, we are projecting a vacancy rate of 10%, and then year 2 and following, it's stabilized at 5%. We forecast modest income growth of 3%, and a collection loss of 2%, which is below our historical averages. We forecast expenses to grow at 3%, and we've historically done a good job of keeping that in line, especially in an inflationary environment. Case in point is Ingalls, where we've come in on budget during these material shortages and inflationary spikes. Debt and exit. Our current bridge loan, as I said, is from LaSalle. Loan to cost there is about 84%, but that should come up because that was based on the original purchase price, which we've negotiated downwards. It's a 30-year. Actually, it's interest only for the duration, and this is not accurate. It's interest only at LIBOR plus 365 basis points, and which is a current effective rate of 3.8%. We are getting a rate cap that would cap us at about 6% if there is an abrupt spike like that. This debt is, we view it as very, very favorable bridge debt. We are projecting a refi in the second month at about 4.5% cap rate valuation, which would put the building close to $25 million. Again, this is around or below where properties are currently appraising. We will refi with, or we will seek to refi with agency debt at the standard 75% LTV. And we're modeling a rising rate environment and rates being close to 4.5 in a year or so. Our cap rate at sale assumption is 5%. We think this is about 100 basis points higher than where we are now. Our macro view is continued cap rate compression regardless of the Fed hiking cycle. This is primarily driven by supply and demand. fundamentals and the abundance of capital pouring into the asset class, as well as our study of long-term rate trends and correlations with Fed monetary policy. And, in the last 30, 40 years, the cap rate chart only goes in one direction, and that's down. So we're not modeling that, but that is our macro view. Quick look at the operating revenue on the T12. You can see their potential market rent. Well, they are collecting about $830,000. Again, mass vacancy, so they could be collecting 25% more. We will primarily increase rent. It is being driven by filling the building and the modest projected rent bumps upon renovation. And we're happy to go over the financials in the Q&A or one-on-one. Operating expenses, we've increased our projection for repairs from where they had it. This is despite the fact that everything's going to be brand new and rolled into the CapEx budget. The landscaping grounds, Phil's team took a look at it, and we were able to get some great pricing there, just as I said, given how great, how compact the premises are. Now, their personnel cost was at $150,000, and it was highly bloated, and it is an understatement, just given the situation of the property and what we saw, might as well be zero. We're modeling to have a on-site property manager and a part-time to full-time maintenance person. And this can be aggregated, this budget can be aggregated with repairs and maintenance, as well as leasing commissions, which get you a salary for 2 people. Their administrative expenses were on the higher side, and part of that was evictions. They were severely hampered by COVID, and once the eviction ban expired, they were able to start evicting people, and that's part of the story as to why they have so many vacant units. The utility costs, we studied it, and we think they have some leaks there. Their water bill is astronomical, and it's actually shocking how much a single running toilet could run your bill up. But we will get to the bottom of it, and we're modeling a reduction there just from finding the leaks. Now, it's important to note that we install low flow toilets and do other energy efficiencies during our upgrades, but we're not modeling any of that in this line item. And importantly, the big expense that goes up is real estate taxes, which are reassessed at sale. Quick look at levered cash flows. Again, this tracks that distribution on 100,000, just at the big picture distributions to all equity partners. So again, we see some light cash flow year 1, followed by a lumpy year 2 cash out refi, and then steady distributions until sale. Sponsor fees, we have a 1% acquisition fee here, a refinance fee of 1%, a disposition fee of 25 basis points, and an annual management fee of 1% on equity. Now, we do want to note that we don't charge any construction management fees, which we've seen done on projects like this with large capital CapEx outlays. Sources and uses. In the model here, we have a purchase price of $18.5 million. Keep in mind there are about 400,000 of credits that are trickling through and reducing our funding requirement. We are raising about 1.2 for CapEx improvements. This is interior and exterior. And then the rest is loan closing costs and funding of loan reserves. All right, next steps. So at this point, we'll open up the floor to questions about the asset, and we are taking soft reservations. Typically, we will fill up before we have our deal documents ready. So we do encourage a soft and non-binding soft commit to get your place in line. Again, we do expect deal documents in the next week or so, but it's likely our commitment deadline will get pushed out by virtue of not having deal documents yet, given where we are right now in terms of timing. That said, again, to make a soft reservation, you can do it through our websites or by reaching out to one of us directly. And so thank you for listening here, and I'd love to open up the floor for questions.
Hey, can you hear me?
Yeah, how are you?
Hi, Mike. How you doing? Yeah, could you or maybe Gunnar talk a little more about the search process? How hard it was to find this one. Why did you find this one? Were there others you got close to that you didn't pull the trigger on? I mean, how did we land on this building?
Yeah, so we, as I was saying, we have a dedicated off-market campaign through Offered. Throughout the process, they connect with potential sellers, and we get the financials, and then they'll either have an asking price in mind already, or we'll try to tease it out of them. Quite simply, none of the before this asset came along, and since we did Ingalls, none of the deals we were seeing or potential deals were making sense. It's a very competitive market, and quite frankly, the prices were too high. I think we got very fortunate with Offered connecting at the right time. These guys just completely beat up from the evictions, and then coupled with the fire, it sounded like they were getting ready to list, and so we caught them just in time. Now, I'd say that we went through about combined off-market and on-market deals between Ingalls and this one in the Colorado Front Range, probably several dozen.
And I drove most of those, and I'm boots on the ground here, and I can tell you it's just a super competitive market. In this market, that is a great dollars per unit.
Yeah, thank you. That's helpful.
Anyone else? Or this might be the least questions we received during a presentation, in which case I'll chalk it up to it being an excellent presentation. But,
yes, I definitely, one thing I want to say on the terms, since I'm on the capital side, these are actually out of market terms on the investor side. They're better than market. Typical deals I'm seeing done, they're more in the 6 to 8% pref. There's usually catch up, and the splits are also not as good. So just from that perspective, I want to give kudos to you guys, Mike and team, about you really want to build your portfolio. Ingalls seems to, knock on wood, going in the direction of a home run. This is a very similar asset. So I'm really, I know I said that twice already, but I'm excited about this deal, and I can't wait how it turns out.
Yeah, so if there's no further questions, we'll wrap it up. Again, don't hesitate to reach out directly, especially if you want to dig into the model or the financials or anything we've covered here. Thanks again, everyone. Oh, and I see a question here come in from Elon Gordon. What's included in 400,000 loan reserves? So that's principal and primarily interest reserves, taxes going forward, and insurance. It's mandated by the lender, and it's kept at the lender. Okay, well, we will wrap this up, and please don't hesitate to reach out. Thanks, everyone.
Thank you very much, everybody.